Hi there. If you are planning to pass on property or savings, this guide explains important UK inheritance tax considerations for over 55s.
For decades, the standard playbook for retirement planning has relied on one golden rule: spend down your ISAs and savings first and leave your defined contribution pension completely untouched. Because pensions have sat outside your taxable estate, they offered a perfectly legal way to pass wealth to the next generation without paying inheritance tax. In April 2027, that standard advice becomes a massive financial liability. Unused pension funds will be classified as part of your taxable estate. For individuals over 75, this triggers a severe double taxation trap. First, HMRC applies a 40% inheritance tax. Then, beneficiaries pay marginal income tax on the remainder. For an additional rate taxpayer, that further 45% levy reduces the original value to just 33%. Sticking to the old retirement playbook will now actively convert a lifetime of careful saving into an accidental, highly efficient windfall for the government. To understand why this pension change is so dangerous, we have to look at the broader tax environment. The Chancellor has frozen the standard individual inheritance tax threshold, the nil-rate band, at £325,000 until April 2031. With property prices climbing naturally over time, that frozen threshold has already pushed many modest middle-class estates to the absolute brink of their tax-free limits. Dropping a previously exempt six-figure pension pot on top of those already strained estate valuations is the tipping point. It will forcefully drag thousands of ordinary families straight into the 40% tax bracket. Business owners and farmers are facing an identical squeeze. Starting in April 2026, a strict £2.5 million cap is introduced on assets qualifying for 100% agricultural and business property relief. Anything above that threshold faces an effective 20% tax rate. Investors relying on the alternative investment market to shield their wealth are losing their 100% exemption entirely, facing a permanent downgrade to a flat 50% relief. Whether your wealth is tied up in a family farm, trading shares, property, or pensions, the government is systematically dismantling the traditional vehicles used for generational wealth transfer. You cannot simply write your pension out of your will to sidestep this new legislation. While it is true that pensions technically pass outside the parameters of a will via nomination forms, the new rules legally compel your estate's executors to calculate the pension's value and declare it directly to HMRC. This introduces intense administrative friction. To ensure the tax is paid, pension providers may be forced to withhold 50% of the funds from your beneficiaries for up to 15 months until the estate's final inheritance tax bill is officially settled. Estate planning has moved from a one-time setup to an active administrative requirement. The legal and financial responsibility for these complex calculations now sits entirely with your family. Let's look at the math. A $400,000 house, $100,000 savings, and $400,000 pension pot. Previously, the pension was safely ignored, leaving a $500,000 tax-free estate. In April 2027, that estate hits $900,000, triggering a $160,000 tax bill. The strategic fix? Draw down your pension while alive. By taking the funds now, you pay basic income tax on your own terms. You can then use the 7-year rule or gifts from surplus income exemptions to pass that cash to your children early, permanently extracting it from your taxable estate. Early, controlled tax payments made during your lifetime are now the only viable mathematical defense against punitive compounded death taxes. The pension rules do not legally take effect until 2027. However, because HMRC requires a full 7 years to pass for large gifts to become entirely tax-free, your window to act is closing right now. Log into your pension provider's portal today. Locate the exact figure listed under your unused defined contribution balance. Add that precise number to the current market value of your home and your total liquid savings. If that combined total breaches £500,000 for a single person or £1 million for a married couple, you are actively in the crosshairs of the 2027 legislation. Contact Fairview Accounting Services immediately. We will help you map out a tax-efficient drawdown and gifting strategy before the window completely closes. Do not let an obsolete retirement habit destroy your family's future wealth. The time to adapt to the new tax reality is today.